Hello and welcome to Macro Matters. This is our informal conversation from the CFA Society Chicago, where we discuss the macro events that are affecting markets today. My name is Lotta Moberg. I'm at William Blair with the Dynamic Allocation Strategies team. Today I have with me Rich Excell and Tony Zhang. They are both of the Geese College of Business of University of Illinois, and we are all also members of the CFA Society Chicago. So welcome, guys.
Thanks for having me, Lotta.
Yes, nice to talk about that, Lotta.
Yeah, it's a little bit of a new format that we're trying out here at the Society to bring to you our recent thoughts and just some highlights from the macro matters. And today, of course, we have to start off with inflation. We recently got an inflation print that was surprisingly high. It was above most expectations. I believe out of the range of the high to low kind of expectations that people mostly cite. You can cite a lot of different sources, of course, for this, but we're looking at a print of a monthly figure of 0.9% and year-on-year figure of 6.2. So surprising, right? Let's kick off by just giving our audience a sense of why does this matter?
I'll jump in if you don't mind, Lotta. So I think to me why it matters is if you look at especially the core, you mentioned the headline was 6.2%. The core was at 4.6%. And if you look back and plot the CPI, both headline and core versus, looking at 10-year treasuries, which is what a lot of people want to look at. This is the first time the CPI has been above the 10-year treasury yield since like the late 70s and early 80s. And if you look at that period, at that time, the Fed was already realizing inflation was high and was already reacting. Policy rates had already started to move higher in anticipation of this higher inflation. At this time, not only do we have the first time and the highest number in 40 years, but the first time it's been above the 10-year, but we have a Fed that's telling you it's not going to act at all. And so I think it's just kind of, to me, it's the juxtaposition of not just the extreme level of the number, but the fact that we're not really seeing any sort of policy action from the Fed. I know they're tapering a little bit, but I think that's where the market starts to get a little concerned. And that's why I think you starting to see, certainly in the short end of the curve around the 2-year period, the market pricing in more than 2 rate hikes at this point, whereas the Fed dot plots are only telling you that there's a half a rate hike priced in, which is telling you that the market thinks the Fed's starting to get behind the curve here. And I think personally, that's why it matters.
So let's just clarify also one thing you said there. When you're saying above the 10-year, you're referencing a nominal number, right? The actual 10-year rate. Now, all we're saying then is that, wow, the real yield of 10 years bond is above 0. That doesn't sound very, something that should be that unusual, right? Should it be unusual and extreme that we don't have a positive real yield on a 10-year bond?
Well, at the 10, you mean the 10-year real yield is sharply negative right now, right? Which has been what the Fed, that was been part of the Fed policy goal really, is to drive real yields negative and to push investors to take risk in other places. And so we shouldn't be surprised when you hear investors say that there's too much money chasing too many ideas. That's been the goal. That's been the goal of policymakers now for several years. And it's working, right? You're seeing people push, you're seeing ideas go into anything from real estate, where we perhaps even had some overcapacity before COVID built in. You're seeing it in digital assets and in cryptocurrency markets. You're seeing it, you saw it before in SPACs. You've certainly seen it in the riskiest places of the market that with real yields that's so sharply negative, it's absolutely been pushing people out onto the risk curve.
If I would think that we would go towards any kind of normal period, though, like I would think that if I think of a long-term perspective, right, as a macro investor, I'm thinking like, okay, what's the normal kind of levels of both inflation and yields? I would think, for sure, I would look at a lower inflation number, but I would also think that real yields will be positive. So just knowing that real yields are positive, and now our benchmark that we're looking at is one country and one maturity, is 10-year in the US. I wouldn't it's not clear to me why this would be a sign of something worrying, just because, oh, last time we saw this, it was kind of a worrying environment, right? I would think that, oh, well, could also be a sign of things normalizing in a way, if it was just a real yield kind of question, right?
Yeah, I would agree with you there, except for I would kind of point to a couple of things. First of all is I think it's not just a U.S. phenomenon, it's a global phenomenon. And we saw that from the data around the world this week. It was not just the U.S. CPI that came in higher than expected. It was Europe the week before. It was, even Eastern Europe, such as the Czech Republic and Hungary this week. It was China on both the CPI and PPI. It was Brazil on the CPI. So it's a global phenomenon that we're witnessing in terms of inflation being higher. You're seeing actually the emerging market countries are already tightening policy pretty aggressively. And it's really the developed market central banks that are erring on the side of being too dovish, if you will. And so I think that there's this pretty strong dichotomy between how you're seeing the countries around the world responding to it. And then the other thing I would say is that, like I said, it's broadening across products. Initially, people thought it was really just the energy price. And that is something that is with us. Oil, oil is incredibly high right now. It's 7-year highs, I think. And if you look at the price of oil relative to the 5-year forward inflation expectations, and again, the Fed cares as much or more about inflation expectations as it does about any CPI print. The correlation between oil and the 5-year forward is about 86%. And so the expectation is that, well, oil prices will start to come down at some point. However, as we know, it being CFA charter holders, ESG is a very strong theme that's going through the market. And it's a lot of this ESG initiatives and the ESG activism we've seen with investors engaging with oil companies is working to reduce supply at a time when demand is going back to not only to 2019 levels, but actually above 2019 levels. And so you've got a really big supply demand imbalance in oil. And so while it's not just the price of oil itself, we shouldn't expect that to really reduce the impact on inflation expectations anytime soon. And so I think you've got a situation where maybe prices are not as transitory as the Fed thought it was. And the Fed is just and other developed market central banks are erring on the side of doing very little.
Right. Tony, you want to give us some more color? Why does this matter, and what else should we be thinking about here?
Yes, I agree with both what Rich just had mentioned, because the U.S. CPI report this week, I think to be more specific, it will be on Tuesday, the day before yesterday. The number came in at 6.2% in nominal and 4.6% in core, which actually was really resetting the market expectation for the pace of the Federal Reserve bond purchasing or tapering, and the timing and magnitude of the change of the policy. If we look at the CME Fed Watch, we can actually see the indication over there. Initially, the whole market was expecting the Federal Reserve will only maybe raise interest rate 1 or 2, maybe at the end of 2022. But on Tuesday, the day before yesterday, Wednesday, now what we have seen is that the timing had shifted dramatically from the end of the year 2022 to the middle of year 2022. The odds of Federal Reserve to raise the first interest rate in June was hiked suddenly to 66% rather than 40%, normally what we have seen. And apparently, this might give a huge surprise to overall the market. Now, people might be concerned about whether the 6.2%, apparently, this is a CPI number, would that become a new normal? What if it become a new normal? That how we actually are going to interpret the asset pricing over the whole market, including bond, including the equity, and everything else. So this actually has caused attention of lots of market participants as well. Also, one more thing that I want to point out was that on Wednesday as well, the 10-year Treasury yield actually spiked 12 basis points, which was typically outside of 3 standard deviation move. 3 standard deviation move was a very rare event. It only happened twice in 2020. So when that happened, twice, the market actually went down 1% to 0.4%. And what we have seen on Wednesday is market went down from S&P 500 about 0.8%. Now, this is how market is interpreting the CPI reading. So now here, what we need to continue to look into is what may be driving the 6.2% inflation, the hike. Would that be the driver, be a consistency, right? So this is something that we need to monitor closely. Same for I think for the market participants as well, whether you are a macro or the micro or the equity or bond analyst. This is something that we need to watch closely. And when people talking about the inflation, especially for normal citizen, what they can feel about very clearly is the full inflation. When you walk into a grocery store, you can feel the price for most of the foods, meat has spiked dramatically. And there are a bunch of reasons behind that. Supply chain bottleneck is definitely one of them. Now, here we want to know whether the supply chain bottleneck problem will continue, right? So that's something that what we want to know. Can Federal Reserve, central banks, and the government do anything about solving the supply chain problem?
It's a rhetorical question. I think we all know the answer to that.
Exactly. So this is very tough. I think something that need to be watched closely. So if we can, the government and Federal Reserve can do anything about solving the supply chain issue, maybe some of the core driver within the CPI reading might go down. The other key component, as what Rich just mentioned, the oil. Also within the CPI reading, there might be other thing, real estate. We definitely have seen the real estate price, asset pricing within the real estate market also raised significantly just over the past 2 months, significantly year over year, month over month. Now with the quantitative easing, the QE provided by the central banks in the US, can the hiking of the price of the real estate market continue like this pace? If we continue, then probably we would not be that optimistic to see the CPI slow down as what central bank has anticipated. So market actually is quite nervous about this. So market actually is really anticipated that Federal Reserve or central bank might have to taper sooner than later. This is, I think, the major issue right now with the market.
If I can jump in real fast, there's a couple of things I want to build on from what Tony said. Is when you talk about the real person kind of feeling the effects of this inflation. If you just look anecdotally at some of the stories that have come across, I mean, one of the bigger ones here for us in the Chicago area is the strike that's going on at John Deere, and where the management proposed a 10% immediate wage hike, 5% subsequent wage hikes the next 2 years, and an $8,500 signing bonus. And the workers rejected it, and they said that's not good enough. And so they're obviously already feeling some effects from the prices in the economy going higher, and you're starting to see that filter into what's expecting. I mean, you see Amazon offering, used to be $15 an hour, now it's $23 an hour. You're starting to see this anecdotal evidence of it creeping through. I know we're not at the point of the 70s where we had the wage price spiral, but you're seeing some evidence of this, and I think you even see that from the president and the administration who suggested that the answer to higher inflation isn't to try to lower inflation, it's to try to increase wages. And so I think that that would be the concern that a lot of people in the market would have, about this inflation becoming stickier than it is. And then the other thing I would add to what Tony said, and it was something we hear a lot, is when we talk about QE and too much money around, et cetera. And there are a number of people that would say, well, that was the concern after the great financial crisis in 2008. There was QE then, and we never got inflation. So why are we going to get it now? But there's a very big difference in the QE we're seeing right now versus the QE we saw then. The QE we saw then ultimately just created bank reserves that ended up back at the Fed. It didn't really make its way into the markets as quickly. This time we're seeing QE where the Fed is very actively involved in the markets, particularly in the Treasury markets and the mortgage-backed security market. And so that money is actually getting in the system much, much more readily than it did before. And I think that's why we're seeing a little bit different reaction to prices than we did after the financial crisis. But I wanted to pivot, and I wanted to get your perspective on this, Lotta, if you don't mind. I mean, how do you think that inflation, whether it's transitory or persistent, how does that start to impact what you think about in terms of like asset allocation, et cetera?
I would say that, latching on to the issue of people are starting to feel this, and the question, why does this matter? In a way, I could say it doesn't matter. It doesn't matter for the economy. It doesn't matter what we mean by inflation, right? We measure it by a basket that has not been adjusted for years, that has changed a lot because of the pandemic. The US has a system by which the basket gets adjusted not that frequently. The European Union, actually, the Eurozone, have a different system where they automatically adjust it in certain intervals. It so happened that in the midst of pandemic, it was adjusted there. So in a way there, it's skewed on the opposite side because it's maybe like an extremely pandemic focused basket. If anyone is using these numbers very carefully, you might want to look into that. I don't know exactly what the numbers look like, but I think that the most important part of, there's been several things here I want to touch on, but the most important part, just by the weight, as we know, is the housing. And I think it's around 25% that is the owner equivalent rent. Now, Tony was talking about the real estate going up and all that. It does. That's what matters for people, right? That's what you can see. That's where you look on Zillow and think, oh, well, what might I buy my house for? Although people with the latest Zillow debacle maybe trust those numbers less. But still, like, that's where you actually see. I don't eat OER, owner equivalent rent, on a regular basis, right? It's a very weird construct. And what it is a people working to construct this survey where they go out and ask people, how much would you rent out space in your home for today, excluding utilities, which is, and people are supposed to estimate this. Basically, if you look back in time, OER, again, owner equivalent rent, has never moved with house prices that much. It's basically constructed. If you ask people a question they can't answer, you're bound to get a very flat line. So we can basically take out a quarter of the CPI, in my mind, that it's supposed to reflect housing. Like, it's theoretically a correct thing to look at as opposed to housing prices, because it's an asset you're sitting on. We shouldn't be estimating asset prices. We should be estimating rents or rents in houses that could become rents if hypothetically. The problem is that when you create it this way, and I could not come up with a better way of doing it, but anyway, you're trying to create this artificial thing, it's just not going to reflect reality. So what I'm saying, it doesn't matter. Inflation generally, rising prices matters a lot. And the things that Tony mentioned, right, was like, well, you go into a store, like, you feel it. The things that we call CPI, doesn't that matter for people in the economy? Now, we're investors, though, so we know that if you want to do your tips versus treasury trading, then it matters. Like, there's an index there that we have created that we call something, that it's the CPI. And that's going to determine a lot of the contracts that we're seeing out there. So whenever you're looking at the contract, that's why we're interesting. I'm very interested in figuring out the CPI. I'm not pretending to think that it reflects what actually matters for people on the economy, that it's a reflection of economic prices rising. Because one, it's a weird thing to say that there's one basket for everyone anyway, we're different. But two, it probably has got a lot of flaws. And I would say the big chunk there, like that quarter of housing, that's part of the shelter. is a really weird one. So that's my general take, and I probably didn't answer really your question, so you can repeat what you actually.
I didn't. I take your point, and I think not only is OER kind of a strange fascination of the CPI, but any sort of the hedonic adjustments are also kind of strange, because I don't think anyone would tell you that an iPhone 13 is deflationary right now because they're going out and having to pay $1,200-1,300 for it. But of course, with all the technology that's in there, it's actually seen to be a disinflationary impulse on CPI. But I guess what I would say is that you're absolutely right that the CPI, I don't think anyone really thinks that it reflects reality, but it's all the measures that we're looking at. It's CPI, it's PPI, it's personal consumption expenditures, it's the inflation expectations that I think the Fed really cares about. And all of those measures are at multi-year highs and at levels that we haven't really broken out on those 10-year measures to all-time new highs, but we're at that highest level we've seen over the last decade. And to me, why that matters is because if you look at the way portfolios have been built for the last 20 years, so think of your classic portfolio like a risk parity portfolio for institutional investors, or a 60-40 or target date fund and portfolio for a retail investor, which is predicated on the idea that stocks and bonds are negatively correlated, and that can reduce the risk of the portfolio, and so therefore you get more of an all-weather portfolio. Well, what we've seen with those types of, we've seen the correlation between stocks and bonds. If we are to move into an inflationary environment, however you define the inflation, the stocks and bonds become positively correlated. If we look back to the 60s, 70s, and early 80s, stocks and bonds were positively correlated because the inflation environment was a very different environment. And if that's the case, if we do go back in that type of environment, then I think the portfolios are really constructed in very much the wrong way. And I think some of the points that Tony was bringing up in looking at the market moves this week, you saw a positive correlation between stocks and bonds. You saw, bond yields moving higher, bonds selling off at the same time stocks were selling off. And historically, when we've seen that, when we've seen bonds selling off and the yields moving higher, it's because people were like, well, the growth must be higher, and so stocks would rally. Now it's an inflation concern, and so you're seeing this positive correlation come in. Again, it's very early and it's ever so slight, but I think that's something that you want to think of as an investor.
I think we might want to explain that when we talk about bond and equity correlation. People cite this differently. You probably refer to the price, right? The price of a bond, which is the inverse of the yield, and the price of equity. Now, the intuition I think a lot of people would have would be, well, if inflation goes up, right, equities go up in nominal terms, bonds are hit by inflation going up because yields go up, so they should go down. So why is that intuition wrong? Because the intuition may be for some that, hey, inflation should decrease correlation, make it negative between those.
Well, I think there's two things that kind of go through that. You're right on the intuition that nominal prices going up should help nominal earnings, et cetera. But I think there's two aspects that for equity investors get them nervous. One of them is the concern that the Fed is going to then have to react and it's going to change the discount rate. But I think the bigger one is the fact that if you look at what's been driving the equity markets to the highs, it's been a lot of, and not when I say I say tech stocks, but when I say tech stocks, I don't mean the large technology platforms that are sitting on a lot of cash. I'm talking about the higher growth parts of the market that where the large part of their value comes from the terminal value because they have negative cash flow. And so these are the longer duration parts of the equity market. And as we know, when rates go higher, duration suffers. And duration suffers in the bond market, and duration suffers in the equity market. And the duration in the equity market comes from the highest value, high growth stocks where all of the value is being assigned to the terminal value. And I think that's what we saw a lot this past week. You might say it was the meme stocks or it was Tesla or whatever it was. It was the high duration equities that suffered the most.
I find this topic is very interesting. Actually, two topics that we both just discussed are very interesting. Now, let me just comment on the second one first. Was like why we see the positive correlation about the equity and the bond market. Rich definitely hit onto that. So I just want to briefly add a few comments because now with equity market and bond market, when is the interest rate is very low, in the low interest rate environments, all of the assets will be inflated. That's why we see, starting maybe a few years back, we see the positive correlation between the equity market and the bond market continuously. Now at a point that equity market reached to a new high. Now the perception or sentiment of investors will become a major driver of market movement, either short term or over the long term. Now, this is a perception can actually turn into the action over the market. It's whether investor will continue to buy or would they like to sell or like to take the profit at this moment. They are becoming very, very sensitive to any change of the Fed policy at this moment. And similarly, in bond market, this the same thing. Now, it's even in the low interest rate environments, like also people are also quite very sensitive. So this is uncertainty created by the Fed policy actually will become a main driver for the positive correlation between two separated markets. This is the thing that I want to add over the second one, but I also want to jump in with a few comments that Lotta just talk about. I find your comment talking about the CPI doesn't matter. It's very interesting. It's the price that matters. That's what we exactly are looking at. Because as what either consumer or from investor perspective, like CPI here, 6.2%, will actually people care about that. Well, what we actually like to see more is whether consumer care about that, right? How consumer will respond if the full inflation continue to climb, or if the other real estate price continue to climb, would they care? For instance, when we typically in the economy theory is when the price of foods or price of goods increase, the demand should decrease. Is that a case, right? Now, actually, from the earning over the past 1 week or two, we find that's actually not the case. Is when the price of goods and actually continue to increase, that the demand also increase. So here it can as like we need to find some economic explanation for what's behind this. So the market actually are trying to understand, or from investors are trying to interpret this kind of misperception. Now, that's why market went down on Wednesday, then pick up on Thursday. Now it's kind of mixed feeling here. Now the market actually are quite sensitive. So this is why I find that the CPI doesn't matter, the price matter. This is quite a good, interesting topic. We can continue to leverage it, continue to discuss over this.
But doesn't it all come down to expectations, though? Let me say a couple of things about expectations. So one, it's interesting. One of you mentioned that, like, oh, that's what really the Fed is caring about, like, is the expectations part. People might assume that there's some kind of consensus about the role of expectations, this thing out there that's called expectations that somehow sets inflation going forward. There really is no consensus in the academic literature, and there's usually there's recently a paper, I believe it was an NBR paper published by an author, Rudd something, Rudd is his last name, saying that, oh, inflation expectations doesn't matter. It wasn't really kind of thoroughly, it wasn't deep, dwelling into it. There was some historical context there. But it's like, it seems that inflation expectations would matter, but on the other hand, like how much actually is kind of debated. But on your point, I mean, I'm thinking, well, if prices start going up, people think they're going to go up more, so I better buy now before prices go up even more, right? That would be kind of like implicitly, we assume that consumers are momentum traders in that way.
Yeah, I agree. And that's where you start to get the permanence of inflation coming in a little bit more. And it's not as transitory, or it lasts a little bit longer than you think. And I think that's what people should worry about, instead of the absolute levels of a number. It's that changing consumer mindset and changing consumer behavior. That is really what we're all trying to kind of grasp at in some way here.
Yes, I think managing consumers' expectation will continue to be a problem for policymaker, government, and central banks.
Yeah.
One last thing I want to say on that, I think you're right. It's going to continue to be a difficult thing for the policymakers. And one of the main tools that the policymakers have used is their communication strategy. And we're at the point right now where we might be seeing a pretty material turnover in the leadership at the Fed at a time when this communication is vitally important.
So a lot of open questions where I think we're going to have to leave it at that. We could be discussing this for a long time. We will be discussing this when we meet in person. And if you want to meet us in person, you should get involved with the CFA Society as well. We have a great group. I'm a co-chair of the Education Advisory Group, so you should definitely check that out. I hope we got a little bit of color on your thinking on CPI here. I think the consensus maybe it kind of doesn't matter, but it matters a lot if depending on how you look at it, how you define it. So thank you so much, guys, for joining me. This has been Macro Matters from the CFA Society Chicago.
Thanks, Lotta.
Thank you, Lotta. Thank you, Rich.